Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode.
Welcome, everyone, and good morning, Patrick.
Morning, sir. How are you?
I'm pretty good. Owen is not with us today as he took the family on holidays. He's back in the next few days, so there's just two of us today.
Yeah, but judging by his WhatsApp messages, he seems to be in a mix of enjoying and not enjoying the part of the world that he traveled to.
Well, yes. So that part are you talking about? Yeah. UAE is an interesting place, especially nowadays.
But you traveled recently a lot too.
Yeah, I like it. I like Dubai particularly. Been maybe twice to Abu Dhabi. What I like there is that actually it reminds me of America a little bit from attitude of people from this point of view and how people want to get stuff done and without making excuses and just pushing forward. That's what I like.
Nice. Yeah. And then you've just come back from Boston, didn't you?
Yeah, we did. We went to Suffolk Construction to record actually maybe 8 hours of interviews with Edify and then the Boost cohort.
Nice.
It was a very good time actually. I love the American vibe, as I already mentioned. So yeah, very good time.
Nice. And Boston in November is certainly a very different experience than Boston in January, I can tell you.
Yeah, you know what? I was very surprised that we actually came and it was -1, and the next day was +20. So that's on the weather side. But it's like a ghost town. It's beautiful, but there's no one in there compared to London, for example. So that was a little bit weird. But overall, very good experience.
And how was the? So you guys, if I remember correctly, you did yet another documentary now with Edify, Dustin's company. How was that?
Yeah, so we did 4 hours with Dustin and Mike, and that was brilliant. You know, we've been actually learning this estimation space because, well, Owen is involved in estimating, me not. But it seems like there's a bunch of incumbents, maybe 5 or 6 firms, which are out there in the market and they are leading it. But the stuff that the Edify is doing is super innovative, and it kind of breaks the status quo in lots of areas. So that's exciting. And also, Dustin is a great founder, so much wisdom there. So you guys watch out what is going to come out of that.
Nice. When will that be?
That will be, so we'll have it done by the end of this year, but it probably will be released January 2025.
Okay, marking my calendar.
Okay, very good. All right, so let's go back to business. So today we are discussing 3 things. We have funding news of Cintoo. I guess that's how I should pronounce it. Then we will go into Thrive Capital and some sentiment in the, capital markets or that's probably the right way of putting it. And the third one, we will have Nico Bonazzo's post that we'll ask Patrick to get some comments on. Okay, so let's start with Cintoo secures 37 million in Series B funding round led by Partech. So I did a little bit of research, and it seems like they are trying to do is to reduce the size of the files for scanning and for 3D data, and seems like I don't know if it's called infrastructure type of application or solution. So I just wanted to get your thoughts about the product, what you think about this funding, and let's go from there.
Awesome. So Cintoo, I think you got it exactly right. In a nutshell, that's exactly what Cintoo is. But let's set the broader context, Martin, right? So the broader context for Cintoo is reality capture in and around either construction sites, could also be industrial sites. And I believe, if I remember correctly, you could theoretically also apply Cintoo in an existing building context. Though the frequency at which you capture would be way different than from a construction site, a project, at an industrial site, etc. So that's the broader context. And in that context, that capture of reality has grown a lot. I wouldn't call it exploding. I think that would be a little bit too sensational, but it is growing fast these past few years. And Cintoo is it's an 11-year-old company. It was founded in 2013. And I would argue that over the first maybe 8 years of their existence, the underlying market context wasn't as favorable as it is now. So that's a very exciting thing here potentially for our good friends actually at Partech who led this race. So I think the overall market context for them is much better now than it ever was in the firm's history. It's favorable, it's growing, etc. And with that comes a problem. The problem is that every scan creates gigabytes in data, and in total they amount to terabytes of data. And that data is supposed to be used for something. You don't capture it only in order to capture it. You capture it because you want to have the as-built documentation. And ideally, you want to automate the as-built documentation. There are players working on that. And for a while, I think Cintoo has been working on that part, basically the as-built comparison as well. But their core product, like you said, is about the data compression to help people actually do a lot of reality capture in various different forms and methods, usually point clouds, and compress that data in order to build much faster data pipelines to do the as-built comparison by hand or automated. And that's where Cintoo sits. We have spoken first with the company in 2019, then again in 2020, when for a firm that age, it wasn't very advanced in commercial revenue, and they had just made a founder switch, which is never a good time to kind of engage with VCs. If your commercial traction is a bit behind where you should be, and you just switched out the original founder, in this case against an angel, so an angel investor in Cintoo, then became the new CEO.
Wow.
And that's it doesn't happen a lot. We have seen it a few times in Construtech. So back then it wasn't a good time for us to get involved, and I think for them also to find investors. And then Amavi, I think, led a round in 2021, if I remember correctly. And so now they raised this round with Partech Growth, and it's important that it's Partech Growth. I'll explain to you.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
In a minute, and of 37 million in order to scale the business. And from what I can see, they have grown since the days we talked to them to where they are today quite nicely. And I think that is a reflection of a great product, good leadership, good management, and an underlying market that is growing.
So interesting. Few questions to that. So maybe I'll start from, you mentioned that the underlying market context wasn't favorable back then. It is now. What is that? Is it there's a more need for scanning, just simply that, or something else?
Yeah, so it's more a need for scanning and more scanning solutions, more advanced scanning solutions. So if you remember the episode we did with Mo from HoloBuilder, Mo was basically one of the, for example, solutions to reality capture with HoloBuilder. And besides HoloBuilder, a bunch of other new tech solutions came up. We discussed, if you remember, you had Jivan here, OpenSpace, Doxel, BuildDots, Indus AI, which is a company that we sold to Procore. There's more and more companies, Evercam in Ireland, in Germany, there are companies that are specialized. It's a very, very it's a space abundant with technology solutions for reality capture, and not to forget the incumbents. Hexagon has products for this, Ricoh has products for this, etc. So that's the first effect, right? So as a, let's say, general contractor, if you use that example, you have abundance of choice. You can really make more informed choices today than you could in 2013 or even 15 or 17. So that's one. And two, overall, the space of capturing or working with as built in your BIM model has just matured in terms of adoption and process readiness than it was, maybe 10 or 11 years ago. So that's the second reason why the industry is just more able to adopt such technology.
Interesting. So is it like infrastructure type of service that they would provide? That's my very lame understanding of it.
That's my understanding as well. I think that's what they are today selling.
Okay, interesting. I like that because it's an offshoot of something else growing, and then they are able to provide for these people like that. Okay, so I researched, and what I found is that the 3D scanning market is projected to reach 16.7 billion by 2030. Do you have well, maybe I will ask that. So do you have companies which do similar thing to Cintoo? And if yes, did you assess them based on this kind of projection of the growing market and total addressable market, perhaps, as well?
So not something currently in the reality capture or the data infrastructure, data processing for point clouds. Not currently. We used to have Indus AI, like I said. We sold that to Procore at a good profit. And I looked at a Finnish company last year called LumiDB, LUMIDB, which is roughly in the same space. We felt good about Lumi. In the end, didn't move forward with it, but that's a company I'm continuing to track. However, the 500-pound gorilla in this space is Hexagon. You cannot dismiss Hexagon because Hexagon has similar solutions in-house. Faro has solutions like that. So this is a space where usually as a VC, when I hear data infrastructure, I typically listen 2, 3 or more times. My ears prop up. In the digital twin space for data infrastructure for the real world, I always have to make a case to myself how Faro, Hexagon, and let's say to a degree even Trimble don't have that solution in-house already. You have to show me a vastly differentiated technology. So that's something I would always keep my eyes open for.
Mm-hmm. Interesting. I was listening a few days ago podcasts, and my favorite one, Vinod Khosla, said something that they invested in TCP/IP protocol when he was in Kleiner Perkins or someone like that, and kind of no one wanted to change the current status quo in terms of the infrastructure or how internet was going, and they saw that being a future. That was interesting, like how people can spot this future trends, which are infrastructure trends. How do you view it?
Well, I think the comparison here is tilted much more in favor of a internet protocol than an industrial protocol. Mm-hmm. And by the way, Cintoo is not a protocol, but I get your comparison. But just to get it clear, it's not a protocol. But the reason why it's slightly tilted, or actually massively tilted in favor of the TCP/IP example, is because the user base is highly fragmented and highly tech competent. So you're selling them a better solution to use their technology and engineering capabilities to do something they can adopt on a micro level for their self. In a case like Cintoo, you won't have a ton of highly technical users. And these highly technical users will need other approvals or need to make it work with other processes that they don't have influence over. So the adoption rate is a much, much different one compared to trying to, in the 1980s or when it was, implement the TCP/IP protocol, starting with, software developers.
Mm-hmm. Okay, thank you for that. So let's touch base on the round itself. So it was led by Partech, and there was also existing investors, Amavi Capital and R. Miller Venture Partners. As far as I'm aware, Partech is not a construction tech specialist. Yes. Feels like it's quite a big run, but that's just my feeling. 37 million led by non-construction tech specific VC. What are your thoughts here?
Right. So let me give a disclaimer, a preface. Martin, everything I'm about to say in the next minute or two is speculation. I have no insight. I haven't talked to, again, Partech are very good friends of mine, but I haven't talked to them here. Also, Arne at Amavi, irregularly we chat. I also haven't chatted to him about this. Everything is speculation that I'm about to say, and it could be absolutely untrue.
Mm-hmm.
Let me first give you context about Partech. So Partech is actually one of the world's oldest VC firms. It's a 40-plus-year-old VC firm, today headquartered in France, but actually it originated in San Francisco. It was founded in San Francisco 40-something years ago, and it still has a US office, etc. So it's a very revered and successful VC firm. The way it is structured is, it's not unique, but it is uncommon compared to how other VC firms structure themselves. Partech has a seed strategy, it has a Series A strategy, and it has a growth strategy. And seed, Series A, and growth all have different funds, and they have different investment committees. And that is important in this case because the investment here came from the growth fund and not from the seed and Series A fund. The growth fund, as far as I can tell, is a fund that plays a multiple game. That means that in growth rounds, you're not saying, hey, I expect you necessarily to be a unicorn. I don't need you to play power law for me, but I need you to deliver a steady X times return after dilution. As far as I can tell, that's what Partech Growth does. As far as I can tell from other investments that I know that Partech Growth has done, they typically shoot for 2.5 to 3x at least. If it's
in
more,
10
that's
years
great.
or in 10 years or
Great question. So no, probably not. So this I'm not knowing, but typically if you shoot for 2.5 to 3x, you would shoot for something 3 to 5 years to an exit, because that gives you the 20 plus something IRR that you want, right? So that would be considered a good venture fund. That wouldn't be top decile or anything, but that would be good. That's investable, right? So now you go in with that. In order to get that out of a company like Cintoo, again, I'm speculating, you probably need to get Cintoo to 20 million in ARR. Right now, so I know their numbers. I will not share them, but they are not yet at 20 million ARR. But I think they can get there in 3 to 5 years. And I even think they can probably get there in 3 to 4 years, is my personal outside-in observation. So now Partech Growth does one thing. They need ownership because they need to put relatively large checks to work. They need to make the assumption, hey, at 20 million ARR, how much can I sell you for? Many people will say maybe 10x ARR. That could be plus or minus. So maybe I can sell you for 200 to 300 million. Again, I'm speculating outside in, right? And so I need to put a lot of money to work because I'm a growth fund. And by definition, I write much less checks, much fewer checks.
By a lot of money to work, you mean this 37 million investment or
something like that? Exactly. Right. And typically, again, not specific to Cintoo, a fund like Partech Growth would make it a mix of primary and secondary. So primary is the company issues new shares and you buy direct shares in the company and the company receives the money. A secondary is an existing shareholder, oftentimes a founder, sells their shares. So the company doesn't get the money, but the founder or the other shareholder gets the money. And typically a fund like Partech Growth in a strategy like this would make it a mix of primary and secondary. So the 37 million, again, that is speculation, might not be money that only Cintoo has received. It might be a mix of, hey, maybe a portion of that was received by the company to grow. I'm pretty sure that is the case. And potentially another part of the funding went to the founders, which for a founding team that has been 11 years in is a completely rational thing to do. And it is very fair. Like Shub and I recently talked about it on Practical Nerds, how you can make arguments for secondaries to make for founders that have been at the company for a long time to re-underwrite another era of growth and a larger outcome. So my speculation here is, I know Partech growth. I know these strategies. It's probably, in my mind, a mix of primary and secondary. Part of it went to the company to grow. Part of it went to the founders. And that way, Partech can underwrite a relatively large check for a company, perhaps to be exited north of 200 million, not necessarily a unicorn. That's, again, not saying that's not the case here. I'm just saying that's typical of such a strategy. And then that way you get substantial ownership and you reduce the dilution for the company. Because normally, and that's the final point here, Martin, when someone reads a 37 million Series B, they will say, okay, Series B, maybe 15% dilution. So it could be like 200 pre, etc. I'm saying that's not what it was. That's my speculation. I'm saying the dilution only happened on the primary portion, which let's say was half of it, right? And the other half maybe was secondary. So it could be, and Partech growth typically wants a relatively large ownership. So that means that this company was potentially valued far below what you would typically guesstimate to be a 37 million round, just because of the strategy that you are following. Doesn't take anything away from the company, but I'm trying to provide context here how to read such announcements.
Yeah. So without the so you are speculating that there's some primary and secondary, but so without the secondary, that you think that wouldn't happen?
So I'm privy to where the company stands in terms of scale, and no, I think where it is in terms of scale, that probably would value the company too highly.
Understand. So I think I get a feeling of this now. So second, speaking of this, secondary shares or secondary, what's the name of?
Secondary purchase, secondary shares.
Secondary purchase. Is it in general a way to boost or motivate founders to a degree?
So that's a rabbit hole now. I really sorry, this is now a shameless plug, but go to our Practical Nerds episode 48 or 49. Shub and I talked for an hour just about secondaries, but the TLDR is, Martin, there are different reasons why you should do a secondary or why you should not do a secondary. And there's a bull case and there's a bear case. I will not reveal my position on this because I don't want founders to reverse engineer my thinking. But I will say there are bull arguments and there are bear arguments.
Sounds good. Let's go to Practical Nerds, episode 48, 49. We'll find out more. Okay. One more question because that seemed to be quite interesting. When you mentioned that the angel became a founder or replaced the founder, was it well, obviously, I don't know how you know or how much you can speculate on this. Is this typically the case where angel replaces the founder because the existing founder is not as great in their job, or they are trying to save the business that they have like vested interest as an angel, or that might be completely different scenario?
That's difficult to answer for me, Martin. So because in the case of Cintoo, I'm actually not privy to that. I don't know how it came to it. We only got to interact once Dominique replaced the former founder / CEO, because when we first talked, the company was already 5 years old, and that had just happened. So I don't know what led to it. So in the case of Cintoo, I cannot comment to it. If your question is more general, I don't think I have a general pattern here. I think there's very different reasons why it sometimes happens. Usually a shakeup like that is hard to make a case that it's a good thing. At first. It can turn out to be a good thing. And I think in the case of Cintoo, that is proven because the company has grown very well these past few years. It has a terrific product. You really have to work with it to appreciate it. It's a very, very good product. Obviously well managed these past few years. So it can turn out to be a good thing, but the moment it happens, it never feels like a good thing. So that's pretty tough to swallow for everyone, the founders, the shareholders, etc. And every case is specific.
Okay, I will ask the last one question on the round, which is why we don't have specialist investors investing in these growth rounds, for example, in construction tech?
That is a very, very good question, Martin, and one that I have a strong thesis on. So it has to do with when companies become obvious. We always talk at Fundamental about hidden in spite of obvious opportunities,
We heard that.
right? And you remember that one, right? So that means that some opportunities in nuanced, quirky markets, which ours might be the most nuanced and most quirky, architecture, engineering, construction, and its supply chains, you can find generational opportunities by looking under a million rocks and appreciating those quirks. But that is not possible by pattern recognition. You can't do that by saying, hey, I saw this in that market and ergo I should find it in construction. It rarely leads to glory. It rarely leads to generational outcomes. And a famous example of that is how people realize that SaaS should not be the default initial model for companies. It could actually be outcome as a service. That's due to the idiosyncrasies and quirks of construction. So that allows you to spot hidden in spite of obvious when companies are not obvious yet to the generic people, but they are obvious to the insiders. So hidden to the generics, obvious to the insiders. Now, here comes the flip. At some point, the company has so much traction, has so much product, so much customer love, so much validation on distribution that it has just matured to obviousness, to generic people. That can be a Series A round. Sometimes it can be a Series B round, like in Cintoo's case. And at that point, the generic investors have no disadvantage anymore. At that point, when it is obvious, it's obvious. And so you don't need any knowledge of the quirks in order to appreciate it. You have other signals that you can use in the business, as I said, traction, distribution, etc., product, to judge that it is a very good company with lots of potential left. And at that point, because that information advantage for the specialists vanishes, the capital advantage for someone that has a lot of capital under management becomes more dominant. And that's why I think personally that you don't see construction tech growth funds necessarily have a huge information advantage over generic funds. Now, just to be clear, Martin, last sentence, I do think that there is a space for construction tech growth funds in the future, but the edge is not an information edge anymore.
Interesting. What will have to happen for these growth funds in construction, specialist growth funds in construction tech to become a reality?
In my opinion, the best strategy to do that, it has to do with having access. So in our portfolio, let me give you a very practical example because it's very public and known. So Inframarket is filing for its IPO. Currently, the firm is at about 3 billion of annualized revenue. It's obvious to everyone that it's an amazing company. It's as obvious as, hey, let's file for an IPO and get as broad a capital base as possible from highly professional investors. Nevertheless, the company only has 4 or 5 shareholders, and Fundamental was one of the earliest ones. Now, we have access or had access to continue pouring money into the company, but the company has not brought on net new investors from outside because why should it? It has a terrific execution and the existing cap table had enough capitalization to keep pouring into it. So at that point, your access into the best companies from the early days of the company is true advantage of pouring growth capital into it. Whereas using growth capital to buy into net new relationships in construction tech, that's better done for a generic investor.
Okay, got it. All right, last one question on Cintoo I've got is, so they are, part of this money will be spent to accelerate its AI and, here is the point, metaverse efforts. Okay, so I'll skip
That's
AI.
That's an old term.
I'll skip AI, but I'm very curious about your thoughts on the metaverse efforts. And right now, where we have again cryptocurrencies booming, metaverse is actually reminding me of the crypto space. So, is there any substance that you're seeing there in terms of metaverse, or that's just some offshoot that they are trying to go into, and that might not necessarily be lucrative?
Thanks for asking the question the way you did. So no, I don't see substance in the metaverse just yet. It doesn't mean, keep in mind one thing, the VC's job is not to make predictions. Our job is just to observe. So my observation right now is no, I don't see substance in the metaverse, but that's the point of technology. It can be a different case in 2 years down the line. So maybe in 2 years, my answer is, hey, now I observe substance in the metaverse. Right now, 2024, I don't. And I would say the whole Web3 that happened in late 2020 and throughout 2021, my God, was that a fraudulent market? Unbelievable.
Speculative, I would say.
Sorry, come again?
I would say speculative.
Yeah, unbelievable. Very speculative.
Yes. Yeah. Okay. Anything else on Cintoo?
It's a great company. And I think if you're not working with them, you should give them a serious look. And also congratulations to Arne at Amavi. This, it serves the company very, very well this round.
Okay. Very good. Let's move on to the next one. So we started chatting about the fact that perhaps U.S. elections are by this time sorted, and seems like the last week and a half, actually, the markets have been booming, being very positive about what happened. And I wanted to gauge your thoughts on what this means to construction tech investor. And you brought up this example, so let's elaborate. So Thrive Capital is in talks to invest around 1 billion in Databricks. How should we interpret that?
So the reason why I brought this forward, Martin, as an example is, so this is literally from this morning. They are proposing a deal at about a 55 billion pre-money valuation. The round size is less important here. 1 billion round size is very minimal dilution. Obviously, at this stage, round about, 2% maybe. So the round size is not that important, but the valuation is. Because if you put it in the context of Databricks ARR, annualized recurring revenue, the ARR currently is at about 2.5 billion ARR. And that means that this is an ARR multiple of above 20x, about 22x. If the 2.5 million ARR that were reported and rumored is correct. So about 22x. Now that signals something, because 22x is very rarely how you would get valued in the public markets for a software business. Now, Databricks is a little bit more infrastructure than software, and that can sometimes help you with the ARR multiple, but there are also examples in the public markets where it was actually punished for that. Most investors at this stage would not believe that long term, you can maintain a 22x ARR multiple for a business like this in the public markets, unless you're generating a lot of cash. Then the multiple could be closer to this, and not necessarily this, but closer to this. Now, the question is Databricks making money or burning money? I don't know that right now. Let's assume it's burning money for a moment, and then I'll come to the other case. If it's burning money right now, then most likely the long-term public markets valuation is far below 22x. That would signal, in that scenario, that Thrive is betting that there's an IPO in the next 12 months, maybe 18 months. If Databricks is printing cash, it's profitable and it's generating cash, it could still signal the same thing, that Thrive thinks here can be an IPO, but it could also be, in that case, that it's more of a long-term holding investment, because they think that, hey, potentially if they keep growing a little bit and they keep printing cash, it might actually be closer to this multiple in the long-term valuation. And then this is a value investment, not a narrative investment. I'm not privy to the profit and cash generation of Databricks currently. But if it is the first, then this is a clear signal that Thrive expects, pun intended, a thriving IPO market in the next year. And I have a secondary data point here that makes me believe that. So someone in the fundamental family recently as recently as a few days ago, had a call with one of the world's largest and most reputed investment banks. And that investment bank told that fundamental family member, hey, And that call happened right after the Trump election.
Mm-hmm.
Now we think there will be a flurry of tech IPOs in the US in 2025. Those two data points together tell me that cash is abundant again, and Thrive is betting on a tech IPO of Databricks.
Mm-hmm. Interesting. Is it not like very speculative again? That the candidates are sorted now, who is taking the office, and there's suddenly like more confidence, and can this become a bubble, or is it as it should be?
Okay, so there's a few questions in there. So let me just take the speculative and the bubble part. So speculative. So first principle, Martin, speculative is only when you don't have benefit of foresight, when you don't have benefit of future information. The founder of Thrive is Josh Kushner. Do you remember the Kushner name?
Kushner. No, remind me.
So the other Kushner is the son-in-law of Mr. Trump.
Okay.
So I'm not saying that they have any political affiliations here, or that there is benefit of foresight, etc. But Thrive is a very successful firm, one of the most high-performant venture funds of that scale in the US. And it has a terrific track record, and I can only assume it has a terrific network as well. So when someone like me has discussions with these big investment banks and they tell me their estimation that there will be a bunch of tech IPOs next year, just imagine what someone like Josh here would have in terms of these kinds of conversations. So overall, he's collecting probably data points to make up his mind whether he thinks there will be IPOs or not. And the more benefit of that foresight you can have, the less speculative it is that you're doing. So that's on the speculative part. On the bubble part, look, economies are always booming and busting. There is no steady growth in economies, and that has to do because the economy is always human sentiment. What I value an asset today and what I value an asset tomorrow is completely subjective sentiment. And that sentiment in the age of social media and in the age of hyper-frequency trading is constantly manipulated. So that obviously leads to constant boom and bust cycles. So is it a bubble? At some point, yes, but I don't know if that's a bubble right now or next year.
No, that's fair. On the IPO thing, I think JD Vance, if I remember correctly, is vice president. And I listened to, I think it was an all-in podcast that these guys are hoping, and there is in the industry, there is a feeling that at that time it was that if he becomes a vice president, then there will be lots of IPOs. It's probably, so I'm hearing it's from different avenues. So it seems like might be something in it. Okay. Do you think that this, I guess positive news in the US is going to spill over to Europe in any good way?
Cool. There's so many VCs engaging in political conversation. And as I said to you in the pre-brief, it reminds me of the COVID days when everybody thought entitled to have an opinion on a scientific matter. Mm-hmm. I don't feel entitled to give my opinion on politics on the public platform. There are people far more, doesn't mean I don't have an opinion. I do, but it also doesn't mean that I'm qualified to use my platform to tell other people what I think they should think about this. Personally, what I will say is just from a purely business and economic point of view, no morals, no ethics, personal preferences, whatever, just purely business and economics. I'm glad that the election is over. Mm-hmm. I'm very glad that Europe had elections this year, and Europe's largest economy, Germany, will have an election in February. I'm very glad that we remove uncertainty for the business economy. And I think that will help us, again, flourish.
So I guess where I was going, is it not the case that for you guys, when you're thinking about deploying money in startups in the EU or US, that was like significant thing, the clarity, I guess it was, right?
Yeah, exactly. Yeah. That's a good thing.
Okay, good.
Well, you're a small business owner in the construction stage. What do you make of it?
So I make of it that US does, within my lifetime, US does everything first and then everyone follows. And it's beautifully illustrated by central bank's announcement. If Fed cut rates 25, Bank of England, that similarly exactly the same, the next day does the same thing. If they raise, they do the same thing the next day. It's actually funny. So I think the sentiment will kind of project onto us. I think, with what we do is, the interest rates are the key really. So, I take it all as a positive thing because there's less uncertainty, as you kind of mentioned. Yeah.
Do you notice any sentiment change in the UK economy? Not like whatever general public or anything.
Since the change of the government?
Yeah.
I actually think it was positive from the amount of inquiries I get in my business. It was positive because I guess before the period before the election time, everyone is like, oh, I don't know. Then once it happens, okay, it's not like we want. I'm not saying that it's not like someone wants, but it's not like we want it. But anyway, we now know, so we can plan accordingly. So it's clean shirt at least. Yeah.
Yeah. Glad to hear it.
Okay. I think anything else on this one, or should we move on to the last one?
I'm just saying I read this as a signal that people believe there's going to be a flurry of tech IPOs in 2025 in the US. And by the way, in India, that's already happening. Sorry, we could have picked this as market sentiment too, market news too. So there was a Swiggy IPO this week in India. 12 billion IPO valuation, raised up 8%, I think, on the first day. And it was a 1.4 billion money raised in that IPO. And then I believe, let me double check, that BlackBuck, which is the convoy or sender of India, wanted to IPO this week as well. It IPO'd yesterday. So BlackBuck IPO'd. 2.7 times subscribed. Can't find the valuation right now. But the overall point is that actually the overall IPO market, even if we look always to the US, in India has already been super healthy. And this week we had the Swiggy and the BlackBuck IPOs. So that's great.
Very good. Need to catch up with Shub as well to find out what's been going on there.
We could have him on for one of these Fridays, actually.
Yeah. That's a good point to see how India is doing. Okay, good. So let's move on to Nico Bonazzo's post, and let's see what you can say about this. So Nico says, actually he's quoting, I don't know, VC logic. So you can only say no to a great founders twice. If you turn them down more times, they will never engage with your VC firm in the future. Let's stop rejecting founders from now on. So the way I read it, so I actually like it, but I don't like, let's stop rejecting founders from now on. Like doesn't sound reasonable, but a rejection of good founders. What does it mean to you? What does it say to you?
So Nico is being sarcastic here. He forgot /s, but he's being sarcastic here. And the VC logic hashtag here is the sarcastic one. So
okay.
Nico says that in a sarcastic tone. I think the real idiotic comment is from the second comment here on the screen, where this guy says, hey, there's zero incentive, and this is not sarcastic, so he means this. There's zero incentive for a VC to say no to a startup unless it's outside the mandate. Saying no blocks optionality, saying not yet keeps them in place. So this is dumb. But it's the reality. So the guy making this comment is making a dumb statement, but he's observing the truth. What he's saying is actually the go-to mode for 99% of investors, employed investors or general partners in the VC industry. They typically, when they pass on a founder or on a team, they try to say something not harmful, not hurtful, not necessarily speaking the whole truth, and more trying to keep the optionality I should clarify, thinking they keep the optionality of further engagement with the founder down the line open by saying something that is not truthful, not transparent, etc. And then sending monikers like, hey, cheering from the sidelines, next round we will bring the rocket fuel, all of these kinds of meaningless statements. And I say that is dumb. It's not how I operate. It's not how we operate. I have actually made the experience that A, founders are tired of it. B, the mature founders, there are immature people everywhere in society, also among founders, but I'm talking about the mature founders. Mature founders will respect you and appreciate you much, much more if you follow my function. And that is truth plus transparency equals trust. So that's how I treat founders. When I pass on a company, which I do several times a week, I write long emails or I get on phone calls and make long explanations of what I'm currently seeing in the business. I'm telling them what I'm seeing as strengths, assets, thesis. I'm also telling them why I can't come across the line right now. And I don't say that in a way where I'm playing the option game. I'm only saying it in a truthful way, but with a respectful tone. And mature founders 10 out of 10 times respect me for it as well and re-engage with me. The immature founders, they might not, but they are not found. That's adverse disselection. So that way I'm actually weeding out immature founders. The mature founders find that very refreshing. And it's surprisingly differentiating, Martin, as a VC, if you don't do what this guy in the comment here is observing, because nobody else plays it that way. They all think they better don't say the truth.
So I actually read it in with my autistic brain slightly differently, that the good founders, like that the VCs cannot spot good founders. The good word kind of led me wrong. That VCs cannot spot good founders, and they reject them, and when they try to engage with them, then they will not be taken seriously. But yes, you had this trust plus transparency equals
truth plus transparency.
Truth plus equals trust, right? Can you elaborate on that? Because I think it's a very, very good statement or rule or law. Can you elaborate on this with the context of dealing with founders?
Yeah, sure. I mean, yesterday I wrote a rejection email to a founding team, and I said to them, hey, this part of the market, I don't believe in. I don't think it will thrive, and your product can literally only address this part of the market. There's an adjacent part of the market that I think your approach can address that I would find very, very interesting. But the problem is your product, the way it is set today, cannot address it. It can only address this first part of the market. And right now, I told them in that email, I thought about it for half a day. I cannot think of a way for you to break out with your product to address that other part of the market. There is no synergy. It seems adjacent, but there is no product synergy for you to naturally evolve there. It requires a different approach. It requires a different product. So the subset of a market that you address with your approach, I'm not interested in. The other part, I am. And so that's something where I'm giving the founders an honest view into my thinking, and I completely make myself vulnerable because a founder could also react very negatively to it. They could throw a temper tantrum, right? They could tell me that I'm an idiot, that I don't get it, etc. Of course, mature people...
That would be immature, yeah?
Exactly. Mature people, great founders, will never do it. They will thrive in having someone actually engage in an honest intellectual conversation with them. In the end, that's scientific method. It doesn't mean that we think we're right. It only means I'm telling you what I observe and the logic I apply to my observations. That still means I can be wrong about it, and we can all be mature, but I try to help you also pressure test your own company. And that's adverse disselection, if you want. So I'm that way weeding myself out from those founders who cannot deal with it. And most likely they will never be great founders.
Okay, spot question. Did you come across situations when you rejected someone, a founder twice, and then for the third time or fourth time, you ended up investing?
Oh, great question. Snapshot, actually. So that was Schub's deal, but Snapshot, Schub makes fun, right? So I think we turned down Altaf 5 times.
Oh, really?
Yeah.
Wow.
So Snapshot
That's interesting.
probably, from me, probably not, but it's also a function of how early I invest. So typically I lead pre-seed and seed rounds, and it's tough to turn down someone twice for pre-seed. It's practically impossible. For a seed round, also impossible. It can happen with repeat founders. So previously they built something else that you didn't like, and now they're starting a new company. Yeah, I think Altaf is the funny example for us.
Okay, shout out to Altaf and Snapshot then.
Yeah, very mature.
Yes, yeah, we had him a few times. Really like him actually. Okay. Anything else on this one?
I mean, I would just say all VCs keep going the way you're doing it, because that way my approach is healthily differentiated.
Okay. So to wrap this up, I have a few, well, maybe last question actually for you. So we've been now 10 and a half months in the year. I don't know if you can share or not. How many investments have you guys made so far this year?
Sorry, I don't have the number right now in front of me. First checks, my guess is 5 or 6, including follow-ons, 10 to 15 probably.
Okay. And what's this time of the year looks like for VCs? Are you guys getting ready for Christmas parties, or like what's the that was a joke, by the way.
Oh man.
What's in plans in the next let's say 6 weeks till the end of this year? Like how are you starting thinking about next year, or how does it work?
Do you want a short answer? Because what you're asking right now, unintentionally, is actually a big topic on my mind that I discussed also with my wife last night. Do you want short or long?
Yeah, let's do the short one, and maybe closer to the end of the year, we will touch on this properly, fully.
It's the busiest time of the year. So Q4 has the most fundraisings going on. It has the most fundraising announcements that obviously influence also, it's propaganda, right? So it works on everybody's mind. So this is the busiest time of the year. No, I mean, the year end is far away from me.
Good. So not thinking of Christmas parties as yet.
Yeah. Well, anyway, I'm atheist, so it's a family party.
That's fine. Okay. Very good. I enjoyed, Patrick. Thank you very much. And yeah, I will see you next week, I guess.
Thank you, Martin. And I hope you can recover from your jet lag quickly.
I will. I am.
Cheers.
Thank you.